Hey everybody, this is Colin podcasting about real estate and welcome to show number 23. My guest today is Kathy Fettke. She's one of the most respected voices in the real estate industry. She's the host of the Real Wealth Show, one of the first ever podcasts on iTunes back in 2003 with over 1,800 episodes and 5 million all-time downloads. She's the co-founder of the Real Wealth Network. She's the best-selling author of Retire Rich with Rentals. And she's a frequent guest expert for major news outlets like CNN, CNBC, Fox News, Bloomberg, you name it. Aside from that, she's also a very active real estate investor and she's very passionate about teaching others how to build life-changing real estate portfolios. So I've known Kathy for many years and I enjoy talking to her today about how a major medical shock started her on her real estate journey, her early successes and mistakes, what she learned from both, the importance of focus and goal setting, why she works so well with her husband and co-CEO, Rich Fettke, the difference between specializing in a specific niche versus trying a little bit of everything. We talked about how the role of women in real estate has changed so much in the last couple of decades for the better. We talk about the real estate market right now, where Kathy thinks we are in the current real estate cycle. And most importantly, I think the last 10-15 minutes are great about the property types, the recession-proof property types any investor can target. I really love the way Kathy boils down her strategy and how she targets markets and teaches others how to do it. So I think you're going to enjoy this conversation. She's super good communicator, really successful investor, and she's helped literally tens of thousands of people to purchase real estate over the years. So hope you enjoy it. And before we head on over to Kathy, don't forget about my website, colininvestments.com, COLIN investments.com. You'll find a range of real estate reports that you can download. You can look at all the previous episodes in the podcast. There's a bunch of videos I put up there, both video versions of the podcast and other videos I've published. You can schedule a call with me if you want to have a quick chat and whatever else you want to do. Feel free to reach out. But that's enough about me. Let's head on over to Kathy Fettke and see what she has to say. Kathy Fettke, how are you doing? It's great to see you and welcome to the show.
Oh, it's good to see you too. I wish I was in Florida actually seeing you, where the weather is probably gorgeous.
It is. It's lovely and warm here. I won't complain about that at all. So I think you're super well known in the industry, Kathy. I'm sure a lot of my listeners will know you quite well, and I think you've accomplished quite a lot. But for those who don't know you, can you tell us kind of how it all started and where you are now?
Sure. I mean, I think people might know me because I have one of the longest running podcasts, The Real Wealth Show, which was really the start of my career and me just desperately trying to understand how to create passive income. As you know, and as I wrote in my book, Retire Rich with Rentals, in 2003, my husband had just come out with a book called Extreme Success. He competed in the X Games and jumps off bridges and, a bunch of jumping.
Wow.
And a lot of extreme sports. So he wrote a book basically on what it takes to break through fear to create success. And he was traveling, the country on media tour. Everything was great. He was coaching businesses worldwide, and we had just bought our first house, had 2 young kids. And really everything was, we were living the dream. And then he went to the doctor and checked on a freckle. He's a redhead, so he has lots of freckles, but somehow he noticed this one freckle that looked different than the others, had it checked. It turned out to be melanoma. He did some further testing and they said, well, it looks like it spread to your liver. And if that's the case, then you probably have about 6 months to live. So that, life is full of surprises. We know that for sure. And that was a big surprise when we really felt like we had it all. And in one day,
So talk about shocks.
Yeah, total shock. Now the good news is Rich is fine today. They cut the melanoma out. He is healthy, but at the time we did not know that. And so we kind of switched roles where if the doctor was right and he only had 6 months to live, he better live those 6 months, to his fullest. And I took over the finances, but I had been a stay-at-home mom for a while. My career before had been in broadcasting in San Francisco. So I still had this little radio show. But I just thought, boy, I don't know how to make the kind of money he was making. We had just bought this big new house, way too big for us. I think the mortgage alone was $4,500 a month. And again, this was 17 years ago. So I didn't know how to make 10 grand or whatever that I needed to make per month to cover the costs, and let him just not work for 6 months. So I used my radio show. It was this little weekend show that I kept after kind of putting my career on pause. I kept that to sort of keep me in the industry. And I didn't have a very big audience because I didn't have a focus. And if there's one, I guess, tip I would give is like, whatever you're doing in life, have a clear focus, a clear goal, something you're excited about. And with my show, it was just random. It's whatever news item I felt like talking about. So it never really took off until I had the focus. And the focus was, how can I create passive income so that I can be home with the kids and with my husband and still cover the bills? So that was the objective. That was my passion. That was my goal. And I just started interviewing people to find out how they did it. Other people who had retired young. I started interviewing people at the age of 30 that were retired. And I'll tell you what, it always came down to a couple of things, really one thing, and it was owning a successful business that created income. And many of those people, that business was real estate. So that seemed to be more often the combination, that they owned a very successful business in real estate. And so I also brought on, as I started to understand this, I brought on a sponsor of the show who was a mortgage broker. And the segments I did for him, I started to learn about the power of leverage. And so that it became, I started to understand that you didn't have to be wealthy to invest in real estate. I think that's why a lot of people don't do it, is they think they have to already be rich. And when I had the mortgage broker on, he's like, no. I mean, back then it was, you could get a loan with no money down. So
no questions asked, no income verification, nothing. Yeah, you're right.
Nothing. So, my eyes just opened wide to this whole new world of how to build wealth in real estate that so few people understood. There was really, like, you didn't learn it in school. You didn't learn it from your parents unless they were in it.
And you didn't have the tools you have now, because there wasn't a ton of podcasts. You didn't have Bigger Pockets. You didn't have any of these online tools or forums, or
there were no podcasts. There
nothing.
were no podcasts.
Maybe the odd RIA hitting here and there, but yeah, that was back.
Well, the RIAs were just selling boot camps that were often outdated and $10,000 for a boot camp. I mean, that's what the RIAs were doing. The real estate investment groups, for those new to that. There weren't meetups yet, so it was just a different world. We've come a long way in 17 years. Let's hope we get a lot further in the next 17 years based on
it'll be interesting
2020. But anyway, I learned so much, and this whole new world opened up to me that certainly my financial planner never told me about. They weren't into it. They tend to be not interested. So, I mean, it's great if you can find a financial planner that likes to see diversification in your portfolio, but not all do. True. So anyway, once I learned, and the power of leverage and the power of, buying a property that the bank basically gives you most of the money to buy, and then you get a tenant in there who pays that loan off for you, but you get all the upside, you get all the tax benefits, you get all the rental income after. I mean, it was like, how can this be? So Rich and I jumped on a plane, and I should say before that, we started looking at properties, but we were in California, and it was like, wow, this doesn't make sense. How are we going to make any cash flow on these? So I had Robert Kiyosaki on the show, and it was then, I think it was by 2005 at that point, he came on and explained how, he had bought California real estate when it was cheap, but in 2004, it like doubled in value, and it just kept going up. So in 2005, he sold everything. And he said that on the show. And I said, well, great. What are you doing now? And he said he exchanged it into Texas. And I said, why? What's going on in Texas? And he explained that, the massive job growth, the high salaries versus, pretty high rents, but low asset prices. So we said, okay, if it's good enough for Kiyosaki, it's good enough for us. And Rich and I got on a plane, went to Dallas, and came back with 5 properties.
And perfect timing as well, because it really took off after that.
It really took off after that. And I came back and talked about it on my show, and people were just laughing at me like, oh, honey, nothing ever happens in Texas. Why would you not buy in California? You could buy in Stockton. Prices are still cheap, which they weren't. You could get a real rough single family home, just dilapidated, for $400,000 that rented for $1,200, but that's what people were doing. They thought that was a good deal. So I was like, no, I just bought a $140,000 brand new, really nice house in a growing area near a bunch of new jobs. And and it rents for $1,500 a month. So I could buy 3 of those, homes for the price of your Stockton home and quadruple my income. So I talked about that on the Real Wealth Show, and our phones ring off the hook with people saying, I want to do that too.
Amazing.
And that's when we created our company, realwealth.com, where we just today still help people find good parts of the country where they can, where there's job growth, where there's population growth, and yet really, really high cash flow.
How many members are you up to now? And any idea how many deals those members have done over the years? I know you've helped so many people.
Gosh. We have it on our website. It's a lot. We have 56,000 members now.
Wow.
Worldwide, I got a phone call in 2009 from a group in Australia who said, we heard your real estate tanked. We have lots of money. Our economy's strong. Their dollar became double as strong, to the US dollar. So they could come and buy our cheap real estate, and their money would go twice as far as ours. So it was an amazing time. So our network went worldwide after that.
That's brilliant. And so you had this awesome start into real estate, selling your California ones and buying into Texas and tripling, quadrupling your cash flow. And you learned a lot along the way, but in one sense, I guess failures teach you a lot more than success, right? I mean, do you remember, what do you recall about it, the mistakes you made back then, maybe leading up to the Great Recession? I don't know. And what advice do you have for people on how to maybe avoid similar mistakes during the next cycle?
Well, I put so many of those in my book, Retire Rich with Rentals, because I do want people to know that when you find out and discover how you can use leverage to build wealth in real estate, and how over time values go up and rents go up, but you're locked in. I mean, it's so exciting. People run out and buy whatever they can. And I really wanted to slow people down to realize, no, you can make a mistake, and here's the things you need to do to avoid those mistakes. So some of the mistakes I made is, one, I was telling everybody to look for cash flow, to sell at the peak in California in 2005, 2006, and buy in markets that were just emerging. And we did that. We ended up buying about 14 properties in that Texas area. But I also kept 2 California ones that were $2 million properties. Well, they were worth like half that by 2009. So that was really a challenging situation. I just thought it would never crash like that. And because people kept saying, oh, California values never go down. Well, that's a lie. I can assure you that's a lie. So that really hurt. We also made a big mistake of buying 3 homes that were construction properties. And I meant to get a construction to perm loan, which means that, I'd get the construction loan to build it, but then it would automatically turn into a 30-year fixed rate loan once it was done. Well, I didn't do that. And I was in the mortgage business by then. I should have known and read the docs carefully, but instead I ended up getting construction loans that had a balloon note. They were due once the construction was finished. Unfortunately, by the time they were done and we had to refi out of the construction loans, the mortgage market collapsed. So our credit was great, and we had the cash to, do for the down payment, but there was no financing. Fannie and Freddie had limited the investor loans to 10, and we had 14 by then. So there was nothing we could do. We didn't have the cash to buy these 3 homes outright.
Sure.
So we literally had to go to the construction lender, hand the keys back. We lost all the money we put into those. And then they resold them super cheap, even though they were worth more. They just, I don't know, they resold them cheap. And in Tennessee, there is a loan. Oh my gosh, I'm going to forget what it's called, but it's you have to pay the difference between what you owed and what they sold it for. So it was a nightmare. It was a nightmare. It was very, very difficult. So that would be the second tip. The first tip I said is be very, very focused, know what you want, have a goal that's clear, because it's really easy to get lost in real estate. Do I do multifamily? Do I do commercial? Do I do storage? Just have a focus. Second, make sure that you're buying cash flow and not doing what I did in California with $1 million property that, absolutely did not cash flow and then lost half its equity. And then third, never get a balloon note, always have an exit strategy for your financing. I think a lot of people got into multifamily over the last few years and got in these bridge loans and assuming they were going to have no problem getting financing later, and just assuming that rents were going to go up and not thinking, well, what if they don't? So I think there's a lot of people in that situation today where they can't get the financing they need because they went on these balloon notes, you know.
I think a lot of people make that mistake. They just assume financing conditions will always remain the same. And one of the best things about buying, single family homes in the US, you get a 30-year fixed rate. You don't need to worry about what your mortgage is going to be doing. It's literally the same price every month for 30 years. But if you're doing different things, those adjustable rate mortgages killed a lot of people back in 08, 09. And obviously, like you're saying, the kind of commercial properties, if you're doing multifamily, those 3-5-year balloons, you need some pretty strong reserves, and you need a plan B and a plan C that doesn't involve bankruptcy, ideally, or doesn't involve, 6 months of madness. So that's, I agree with you. And I've seen smart people make the same mistakes. And I've been lucky to avoid it, partly because I was just very young back during the last recession. I was old enough to get my ass kicked a little bit, but not old enough to have a high value of assets, which is just luck. But, there's a lot of options with real estate, Kathy. You touched on it briefly. There's tons of property types, lots of markets, lots of strategies you can employ: buy and hold, flipping, wholesaling, mix of all the above. What's your opinion on the pros and cons of trying lots of things and doing lots of things versus going kind of deeper on a specific niche?
Well, I'm the first to be guilty of getting excited about the shiny object. I was jealous of other people doing multifamily when we were doing single family, and jealous of people doing storage units. It just sounded so good, but I just didn't understand it enough to dive in. We did make one big mistake on investing in a wine village that I have no business investing in. I don't understand it well enough. The basic business plan looked great, but to pull something like that off has been difficult. So we're still working through that. So I would say choose one and learn everything you can about it. If you like multifamily, read 3 books minimum from beginning to end. Have a mentor. Maybe start small. Get a smaller, 5 unit or a 10 unit, just to get used to it and build your way up. Some people might not agree with me on that, but I just think there's so much to learn. Even if you're investing in someone else's deal that someone else is managing and you don't have the experience to review their business plan and really double check their numbers, you can end up losing that money. So understand your asset class inside and out. On your first deal, I recommend partnering with someone who's done it a lot of times over and over again successfully. Even if you make less money on that first one, you'll learn a lot. Mm-hmm. And then you can decide to learn a new asset class once you've got one mastered. But, again, doing a bunch of things, they're all exciting for sure.
It's hard to resist the temptation, isn't it? When when you want to do it and you can see it's like the shiny objects in it, it's very hard to resist. And sometimes they work out great, but
sometimes they don't. The only exception I would make to that is if you're investing in someone else's syndication, someone else's project, and you want to try storage units and someone's raising money for their purchase of a storage unit, and they've done it for 20, 30, 40 years successfully. Okay, sure. Fine. And the same, then you say, but I also want to be in multifamily, so I'm going to invest in this guy's deal, and they've done it for 20, 30 years successfully. Then you can diversify. I think that's okay. But when you're leading it, there better be someone on the team who's done it and done it well, because you certainly don't want to be the guinea pig. Someone else.
I agree. I've invested in some loan notes with Dave Van Horn, because I know he knows what he's doing. He's been doing loan notes for 20 years. I don't know how he manages getting all those non-performing seconds into performing, or repossessing it first and flipping it. That's his deal. I wouldn't do my active income with that. I'll do my active income with a single family home in Tampa or something like that I have experience in. But you're right. Passively, it's great to diverse if you double check who's leading it. But if you're leading it, pick something and stick with it. There's no right answer. Is single family better than multifamily, or is this market better than that market? But like you say, if you pick something, get good at it, there's no reason why you won't be successful.
Yes.
That's awesome. So one thing I've always loved about you, Kathy, and your husband, Rich, is just how focused and how clear you guys are on your values and where you want to be going personally and business-wise. And I know Rich has this awesome thing he does every year, what's the focused mindset. And I think it's great. But there's a lot of talented people out of the opposite. They just have these limiting beliefs. They're literally getting in their own way of success. I mean, what kind of, can you elaborate a little bit on how you lead that part of your life and what kind of principles might be helpful for somebody that's, kind of tripping themselves up on the way to success?
Well, I mean, the most important thing is to understand that normally opposites attract, and the person that you're married to is probably the opposite. And that may be what initially attracted you, but then very soon it can be the thing that drives you absolutely crazy because they're different than you. What Rich and I finally learned is that our differences, when combined, make a stronger unit, So okay. He is more of a detail person. He's a planner, an organizer. I'm a jump in and let's figure it out type person. I'll start businesses, but I won't run them well. So I'll get the business started. He'll come in and run it well, So once we really figured out what are our true strengths and how do we honor that in each other, it really came to light one time when I saw a shiny object. This lady, really fancy lady, I think she'd won The Apprentice, and she was, wearing this fancy suit. And I was so impressed with her, and she was selling these condos in Las Vegas, and everything looked so great. And I came home, I'm like, Rich, I want one of these. And, she was on The Apprentice. She must be great. I must be able to trust her. And he's like, well, he started questioning everything. And the more he questioned, I was kind of getting mad. Like, why are you questioning this? Mm-hmm. And finally, it was just like, wait, we're a perfect balance for each other. So we went through it, and I let him ask his questions, and I tried to answer them. And by the time, when we went through that process, he was right. And in the end, it really came down to him saying, I just don't feel right about this. He said, okay, great. We didn't do the deal. And it ended up being a horrible deal, and we're so glad we didn't do it. So, yeah. There's people that usually like to make quick decisions, and there's those that make slower decisions. And when you can combine your strengths and really listen to each other, like what he needs is all the data. And then, so as long as I give him all that data, then we can move quickly. But if he doesn't have it, we can't move quickly. So just really understand each other. That's one thing. On the other, he has forced our company to be focused. And one of the ways to do that is to have very, very, very clear values. But he's done this with our marriage. He did this with our wedding. He raising children. Wow. It's like with the wedding, think about just how overwhelming that in itself is. And he was able to just sit us down and say, what's the most important thing we want from this? What if we could, look back on the wedding, what would be the standout? And it was like, the great dancing, just celebrating our love with our loved ones. And it was like, okay, here's our values. Here's the things that matter. What doesn't matter? The color of the tablecloths. You know what I mean? The flowers doesn't matter. And so we ended up having an amazing DJ, really good wine. We had just incredible party, and the details didn't matter as much. So it's the same with raising your kids. Like, what's the most important thing? Is it that they got their homework right, or is that they knew that they could come to mom and dad for quality time to work through the homework? Getting clear. So the same with our business. We have really clear values. It's called Atomic. So all those stand for different things. Accountability is one. A for it's Atomic Accountability.
I remember him mentioning that in a meeting somewhere, but yeah, I'm stuck I can't remember what it means either, but it made a lot of sense. I'll dig it out.
Yeah. Transparency, mastery. So these are values that we hold in our company for our employees, and for our investors, so, and the people we work with,
No, I think there's a lot to be said for it, and it's something I want to continue to improve on. I mean, it's too tempting just to go through life, just run without stopping and thinking, well, why, and where do I want to be, or fast forward 3 years and look back, what do I want to see and how do I get there, and just kind of approaching it, going through the effort to approach it that way. I think it's a very worthwhile exercise, particularly if you're trying to transform your lifestyle or trying to transform your income streams. It's the way Rich does that, I think is very powerful.
It's really important. Yeah,
it is. And speaking of Rich, I mean, speaking of real estate, you know, your real estate used to really be a man's world, and that's changed a lot, obviously, in the last 10, 15 years. And obviously you've seen that being in the business for a while. I mean, what advice, Kathy, do you have for women in this industry, and maybe particularly busy moms out there that are determined to create wealth and create that financial freedom that so many people have through real estate?
Yeah, I guess they're calling me a pioneer now, because I was one of the first women on stages speaking about real estate, and you know, with, you know, a stage full of men, and then there was me. I would say that women really do understand residential real estate in particular. You know, women, it's always been said that women are the ones that choose the house, you know. So we understand what families want to live in. It's you can learn it, you can grasp it. I didn't understand the stock market. It didn't make sense to me. And when I learned real estate, it was like, I get it. So that's number one. Number two, I think I watched my mom know a lot of things, but never take the action on it. Like, she just knew, but she didn't feel like she was strong enough to have a voice at the family table when it came to finances. I think that's changed a lot, but that's the older generation. So I think when I sort of opened the door to be like, hey, I'm a very important part of our financial decisions here. And when I get up on stage, it was always men in the audience. And then slowly, you know, the wives would start to attend, and because they wanted to know what their husbands were doing with their money, they started to attend these events, and then they started to really dress up, and then they started to want to be in the meetings with their husbands, and then they wanted to have a voice, and it was amazing that they hadn't. Again, I think a lot of that has changed, but it's been really beautiful to see that transition just in the last 17 years, where women, you know, wives were starting to feel like what they wanted mattered, and that they had the power to speak it. So if for what that's worth, that's the shift I've been seeing. And what women need to understand is, maybe you have a feeling about something, back it up with the facts, you know, read the book, understand it, so that you can speak the same language when you're sitting at that table and you know what's going on. We had a very, very unfortunate situation where one of our investors invested his wife's money, bought a bunch of houses in Texas. They were great acquisitions through Real Wealth. We helped them buy really good properties. What I didn't know is that he used her IRA to buy these homes, and had her sign paperwork. She didn't know what she was signing. She just didn't even bother reading it. She just was like, it's too much for me. I can't understand. Just do it. So when he passed away suddenly, she had no idea where anything was. It was all in title in his name. He didn't mean to do it. He was trying to help their family, but unfortunately, neither of them understood it well enough that everything was in his name, and Texas law made it very difficult for it to get in her name. And she's had to fight it, and we've been trying to help her. So anyway, don't sign things that you don't understand. You know, it's okay to ask the questions and make sure you truly do understand and be a part of your finances. You know, too often someone does pass away and the other person doesn't know what to do with the finances. So it's better to do as a family.
I agree. And I know my wife started getting nervous when I started buying rentals around the place, and she didn't know what was going on where. And so we just created a document with everything on it. This is it. This is where it earns. This is the guy you contact. This is the property manager. This is the mortgage number. This is everything, just so that you have that peace of mind. And she was, you know, smart enough to kind of demand it and say, you know, I trust you to kind of make some real estate decisions, but I need to know what it is if anything happens to you, you know. And I agree. And yeah, I agree. Women are far more involved now, and they're in many ways far smarter and maybe less prone to taking stupid risks as well. And
I don't know. It's not even a male-female thing. It's just a personality thing. It's usually opposite facts. So somebody in the family can be more reckless than the other, and which can be a good thing. It's that person that will get things going and get you making deals.
Yeah,
but
taking action.
But if you've got that other person saying, before you take action, I want to see the checklist, I want to know these things were done, then it can be a great combo.
I agree.
And I'll
It's a
tell you,
perfect
Rich and I,
combination.
we meet once a week for an hour to go over the finances together, so we both know exactly what's going on.
That's a great idea. I love that. That's a great idea. And I mean, what do you have, like a special piece of software you use to kind of track all the assets? Is it, what do you mind
Just
sharing what it
QuickBooks.
is? Just
Yeah, just
QuickBooks?
QuickBooks and a really good bookkeeper now that that we got from belay.com. Belay, they offer bookkeeping assistance, and for us, we're both too busy now to really do it. So he puts everything together and then we review it together.
I love it. And let's pivot to the current market, Kathy, because I know you really have your finger on the pulse, and you have some really educated guests on your show as well, talking about current market trends. I mean, how crazy has the last 6 months been for you, and where do you think we are in the current real estate cycle?
It's really interesting because what I learned from Robert Kiyosaki on my show 15 years ago is still true today. And I'm so pleased to say that the focus that we have had has held up through the Great Recession of 2009, and it's held up this time too. So that's great news because, of course, I'm always be questioning when we've got 56,000 investors kind of following my advice. You kind of hope you're going to be right. So the advice really is very simple. It's find properties that are near jobs and specifically properties that the average person can afford. When I say affordable real estate, people think low-income housing, and I'm not talking about low-income housing. I'm talking about if you go to a place like, say, Tampa, you want to know what the average income is for the area and what the average person can afford. And that will give you an idea of the largest number of people who can afford what you have to offer. That's important to know. Now, hedge funds have a very clear buy box and a niche that they have. It's a little bit higher end than what we focus on. We want to be sort of in the middle income area where, again, the average person can afford, and that brings more people who want to either rent or buy our homes. So, and being in areas where there's in-migration, the migration patterns are showing that people are moving there, that jobs are moving there, that the laws are landlord friendly and business friendly. It's attracting business. It's not like we wouldn't invest in New Jersey or New York or California because they're not business friendly and the taxes are high. Why would we do that? So if we're going to build homes or we're going to have rental properties, it's going to be in places like Nevada or Florida or Texas, where they welcome our business and they respect landlords. That if somebody doesn't want to pay you rent, they don't get to live in your property. That seems like basic math, right? Yes. So these are the things that we look for, and it's working. So to give you just a simple example, going back 10 years to the worst housing recession, we helped one lady who owned 3 rental properties in Stockton, California that were about $400,000 each. They rented for about $1,200 each. Terrible deal. But that's as good as it got, right? That's all you could get. And they were in C-class, maybe even D-class neighborhoods. These properties were in constant need of repair. When she met me and heard me on my Real Wealth show, she's like, wow, you bought all these $140,000 properties in Texas that rent for more than my $400,000 property. So she sold her 3 properties. She had about 1.2 million that she could exchange tax deferred into these Texas properties. We were able to help her buy 9 instead of 3. She sold 3. We helped her buy 9. Her cash flow quadrupled. And we chose that specific area because we knew there was a new freeway coming in. There was a lot of investment into that area, a lot of businesses moving there. When I see a city investing in itself with freeways and new libraries and new schools, that is a sign you're getting in front of the path of progress. So $140,000 was a lot of money in Texas. I mean, the average home price was $120,000. So we kind of went over the average there, but we saw what was coming. Well, anyway, during just a year or 2 later, after she sold her properties and bought those ones in Texas, whoever bought those $400,000 properties in Stockton, those properties were worth $75,000.
Wow.
18 months after that person bought them, after she sold them. She would have lost everything. The person who bought them from her lost everything. On the flip side, she had quadrupled her income. She was able to quit her job. She was making so much cash flow. That cash flow only increased during the recession. And
the
then
more people are renters, right?
more people became renters. These were nice homes in a good area, near jobs, with really good schools. So her rents just went up. She was making more money during the recession. And then right around 2012, when other people started to see what was happening in Texas, the value started to go up. Now those properties she bought are worth about 450. So she has tripled the equity as well. So her 1.2 million is probably more like 4 million now, and more cash flow. So that's an example of doing things right and not having to worry about recessions. So we had the same thing this time around, where we were looking at where's the job growth? Where are people going? Well, it's clearly the Southeast. Millions of people moving there for all the reasons I just said. Jobs, low taxes, affordability, good climate, and they're moving to the Southeast, and you're still able to buy properties in that $140,000 range. Prices we were paying 15 years ago. That's incredible. Now, for a new home, you're going to be closer to 200, but you can buy an older home for pretty cheap in areas that are slated for growth, like no question. So here we are in a recession. Guess where people are moving? To where it's cheap, affordable, where they can have more space. We're busier than ever. We have more people wanting these homes, more people wanting to rent these homes. So
it is amazing how people complicate something that you can boil down to something very simple. Go where the population's growing, go in the middle class and lower middle class areas. That's where there's most of the renters and most of the homeowners are in those areas. Keep your reserves, and over time you're just going to do great. And the kind of really low income is high risk. The really expensive bling houses, they're high risk whenever the market turns. But that kind of middle area, that middle of the ladder, or one rung below the middle of the ladder, you're right, that is basically recession proof. You have to weather a storm every 10 or 15 years. And if you have your reserves in place and your numbers are organized, like you're looking at your QuickBooks, you're keeping an eye on your monthly statements, you're going to do fantastic. Like that great example you just gave us.
Well, even at a time when, it couldn't be scarier, where we've got eviction moratoriums, and it's like, oh my gosh, people can literally just not pay their rent. Guess what? They're paying their rent because, the one thing people don't want is to end up on the street. And if you get evicted, where are you going to go? Who's going to rent to you? So even when they have the opportunity, they're still paying their rent. It's more important than maybe the other things they used to do, like maybe getting their nails done or going to the movies. They're going to have that money go to their rent. So we've seen higher collection rates. Obviously, home sales are through the roof as people realize, everyone's like, oh, it's going to be all these foreclosures. Same thing. There's people who are legally allowed to not pay their mortgage. But banks are just going to put it at the end of the loan. There's not going to be a flood of foreclosures.
And there's so much equity in those homes anyway. I mean, they're just, like you say, to tag it on.
They just put it on the market, sell it. It'll sell in a minute. Yeah, I don't see a flood of foreclosures coming. There will be an uptick probably, but only really good people who know how to find those, like you, will be able to take advantage, because it's still a lot of work, right?
It's still a lot of work, and you're right. I think there will be an uptick in foreclosures, maybe a big uptick. I don't know. Maybe the evictions will cause some. I'm not sure, but I think the demand is there to absorb the inventory. That's for sure. It's hard to see where excess inventory is going to come from anytime soon. I mean, are you pretty bullish on kind of real estate for the next year or so? Would you, if people are looking to kind of add to their rental portfolio or start their rental portfolio, is now the right time to start? Are they going to gain anything by waiting 3 months or 6 months or a year?
I think the only thing they'll gain is they'll have to pay more if they wait, and maybe rates will go up. I just did a news story today on my real estate news podcast that mortgage rates may be at the lowest they'll ever be. So you might be paying higher rates, not much higher, but a little higher, and higher home prices. Rents could potentially go up to offset that. But no, what people really need to understand is that this time is very, very different than 10 years ago. 10 years ago, we had oversupply. We have 25 million more people here today than we did 10 years ago, yet we haven't
Is that
built.
right?
Mm-hmm.
Wow.
We haven't built to keep up with it. So, builders, especially in sort of tier 2, tier 3 cities, The builders just weren't building. They were building in New York, they're building in San Francisco, and these, the big high-end condos. Builders were making money on the high-end stuff, but they weren't really able to make a profit on affordable housing. So again, affordable, I mean the kind of property that the average person can afford.
Like a $200,000 or $250,000 home. Builders haven't been building those, but that's what most people can afford. You're right.
Yeah, there's no profit in that. Maybe 20 grand. They can make 200,000 profit on the high end, or $1 million. Why would they do a little house like that? So even like a place like, I can't even believe it, in Cincinnati, Ohio. This is the latest news from our team in Cincinnati. 20% increase in prices over this COVID time. And you cannot find a property. Because guess what? Builders were not flocking to Cincinnati.
And Ohio is supposed to be the flat, kind of steady cash flow market without the appreciation, right?
They don't know what to do. They've never seen a multiple offer. They don't even know what that is. So it's all these areas that were kind of off the grid. Again, tier 2, tier 3 cities that didn't have a flood of builders coming in to keep up with growth. They have a lack of supply, and that now you've got these people saying, I don't want to live in an apartment. with low interest rates, I can actually afford a home, get a mortgage on it, 3% down with FHA loans. And they can, the home has become, it's just moved up to probably the most important thing now, because it's everything. It's your office, it's your daycare, it's your school,
your school,
it's your restaurant, it's your entertainment, it's everything. So, you're not going to be wanting to be cooped up in a small apartment where you can't even use the facilities, because, everyone, I think, is wondering, boy, are we going to see more viruses like this? Is this the future? And if it is, I want a good place to be during it.
I love that. I love the way you boil that down, that, people, what should I buy? I mean, target tier 2 and tier 3 cities, target middle class areas, target solid properties that are solid cash flow now, and just wait, just wait it out and own it long enough. You'll do fine, right? So I guess people overthink it a lot, and they overthink a lot of things. What if this happens? What if that happens? I mean, lots of stuff is going to happen. I mean, look, the election is obviously a big one, Kathy. We're recording this a week before the presidential election. It'll be broadcast afterwards. I mean, is this just another good example of the name of the next president shouldn't affect your real estate strategy? I mean, it'll affect other things, but it shouldn't affect your just pick a strategy and don't worry if the president's Republican, Democrat.
Don't worry. I mean, it's been a heated year. But at the end of the day, you've been in real estate through different presidencies. Our company, Real Wealth, has done well during all, Bush era, the Obama era, the Trump era, and whatever's next. Maybe by the time this broadcast, we'll know who our president is. Maybe we won't. Doesn't matter. Will certain tax rules change? Possibly, but you shouldn't be buying your real estate based on that. I do believe that residential real estate is highly protected by the government, because it is such a huge part of our GDP. When you look at the trillions and trillions and trillions of dollars that have been printed in the last 6 months, where did that money go? A lot of it went into mortgage-backed securities to keep lending, to keep the housing market moving, and to lowering interest rates so that people can buy. Why? Why do they care so much about housing? Again, it's one of the GDP numbers that keeps the economy afloat, and they're going to keep housing afloat as long as they can. So I think that's...
and who guarantees like 70-80% of the mortgages? It's Fannie and Freddie, which are quasi-government entities, right?
Absolutely. So once you kind of see where that money is going, the trillions of dollars is going into real estate, that tells you something. It's not necessarily going into commercial real estate. It's going into residential. So there's some going into commercial, but that tells me a lot. And I really don't think that banks are going to want to flood the market with foreclosures if people can't pay. The people who can't pay, it's not their fault. They were not allowed to work. If you own a business, you were not allowed to go to work. So how could it be your fault that you can't pay your mortgage? I think there's going to be forgiveness. I think there's going to be loan modifications, and I'm not worried about it. So no, we're going all in. We're going to start another fund. We're hoping, you could be a part of that.
Well, what's it going to do? Do you want to talk about it? What's the new fund going to be?
I actually don't know if I can talk about it.
Okay. All right. Well, you can tell me off air.
Yeah,
That's
yeah.
fine.
You have to be a member of the network due to SEC rules.
I got you.
Yeah.
Well, okay. Well, look, this has been a super enjoyable conversation, Kathy. I appreciate all those insights. How can listeners learn more about you, your show, your website, and the exciting investments that you help people do?
Realwealth.com is our website. That's real, like real estate, and wealth, like your money. And then when you go to Real Wealth, you join, it's free. And then you'll get access to so many webinars on asset protection and financing and, how to read an an inspection report and an appraisal report and really understand it. And there's lots of free information there. And then a list of people in different markets. Well, first of all, lots of data on the different cities that we think are great places to invest today, and a list of people we share our teams basically in those markets, just like I did when I helped that woman sell her California property and buy in Texas. So you get all that at realwealth.com. I also have the Real Wealth Show podcast, and then Retire Rich with Rentals on Amazon.
Perfect. Well, thanks again, Kathy, and let's stay in touch. It was great chatting to you.
Thanks so much for having me on.
There you go, folks. That was Kathy Fettke on episode 23 of Colin Podcasting About Real Estate. I hope you enjoyed that conversation. I certainly did. Kathy's a really good communicator. She communicates her ideas really clearly. I love how she's so, focused on her goals. Her and her husband, Rich, they've built a really successful multi-million-dollar business together. She's got a great podcast, been cranking out literally a couple of thousand episodes over the last, 15, 16 years. She's a bit of a pioneer in terms of women in real estate. And yeah, it was an honor to have her on the show. I hope you guys got a lot out of it. I think the last 10, 15 minutes were particularly good about putting in perspective, just the long-term nature of real estate and how the benefits of real estate accumulate over the long term. And if you get too focused on, is now the right time, and is this going to affect it, or is that going to affect it, it's kind of beside the points. If you have your rules and you stick with them, your rule might be on buying middle class properties below $160,000 in this tier 2 city or that tier 3 city, and I'm going to hold them for the long term and get them professionally managed. You're basically going to be fine through whatever boom and bust you'll be going through during the next 15, 20, 25 years. And although clearly the pandemic is a major life-changing event, even that hasn't knocked real estate off sync. And even if it does cause a fall in prices next year sometime, it still shouldn't make much difference to any buy and hold investors. Prices will always go up and down over a 15-20 year period. But if you stick with the fundamentals, use the bank's money to pay for most of it, use the tenant's money to pay it down, take the tax advantages, the inflation advantages, the tax cash flow, everything you can think of, you're going to do just great. So, bear that in mind, get your reserves in place and just get educated and take action. I mean, that's part of what this show is about, helping people to get the information they need and hopefully the motivation they need to get started. And if you ever want to chat about your real estate journey, feel free to reach out to me. Just go to colininvestments.com, COLIN investments.com. You'll see contact me there. You'll see a bunch of other reports and links to videos and podcasts. And that's pretty much it for me today, though. Thanks for tuning in. Don't forget to leave me a rating or a review if you're enjoying this content. And apart from that, I will be back again soon with show 24. And until then, you guys take care. I'm out of here. Bye-bye.